Hi everybody, this is Dave Barnett with Attract Capital. We're coming to you live from the Attract Capital headquarters in Long Island. Before we get started with today's webinar, which is the coming need for transitional capital, it's time for us to take a sip of our favorite hot beverage. I think you'll like my mug here. Keep calm and carry on is the slogan. I think it's very appropriate. So let's take a sip before we get started. Okay, that tastes great. So the coming need for transitional capital, it sounds a bit ominous, and I think by the end you'll kind of understand what I'm getting at. It is a very serious subject because what we're talking about is pretty much every middle market and small business in America needs transitional capital to get through this market dislocation that we're experiencing right now. And so there's really two parts to this. How do you calculate what amount of transitional capital that you need, and where do you get it? Two very important things. You can't do one without the other. The transitional capital, I'll break it down for you, has two pieces. There's a working capital amount, and then there's a growth capital amount. A lot of times people confuse the two and combine them, but for the purposes of understanding it clearly, it's better to separate the working capital from the growth capital. And we'll show you how to do this. So why is this so important right now? I mean, I think it goes without saying, but capital strength right now is destiny. So if you're a company and you have the capital to carry on and to go through this crisis, you can rebuild your business and you can become stronger because not all of your competitors are going to be able to come out on the other side. And it sort of reminds me of a quote that the great Warren Buffett once said, "You never really know who's swimming naked until the tide goes out." So what did Buffett mean by that? We've had a receding of liquidity in the economy. So basically, businesses that were thinly capitalized or just averagely capitalized, they don't have enough money to get back going again. And so what it's going to mean is most of these businesses are not going to be able to move forward. And if you have capital, even if you don't have the best product, even if you don't have the best service, even if you're not the strongest company, but if you have capital strength, you're going to win. And if you don't have capital strength coming out of this crisis, you're going to struggle and you may even lose. So where are we right now? I think it's pretty obvious we're in a bad place from an economic standpoint. We are going to have a big recession. I'm pretty certain of that. We've had a strong government response, which I think has been very positive. We've had these SBA loans, these disaster loans, these paycheck protection loans, but it's not enough. It sounds like a really big number. It's $2 trillion in total stimulus, but it takes a while to get it out there. And I think the government has done an admirable job of racing to get it out there. If you look at the stimulus package in terms of how quickly it was passed versus the last big stimulus that we had in 08 and 09, it's been passed at warp speed. But it's not going to be enough, unfortunately. So it's enough to perhaps hang on, but it's not going to be enough to restart your business. And it's certainly not going to be enough to sustain your business to come out on the other side of the crisis. And the only way to do this, and this is what we've been doing for the last 20 years at Attract Capital, is through capital planning. Okay, it's not a word you hear every day, but really capital planning for your business is the most important thing you can be doing right now. So there's two main parts to capital planning: determining the right amount of working capital and the right amount of growth capital that you need. And really all of this is aimed at reliquifying your balance sheet. So how do you calculate the right amount of working capital for your business? Working capital, I'm not going to go into the definition, but working capital is your current assets minus current liabilities. And the way to look at this, having advised hundreds of companies over the last 20 years, is you want to look at your working capital as a percentage of your revenue. And you want to look at it over the last couple of years and you want to average it. So for example, if you're a $10 million revenue company and you have $2 million in working capital, you've got a 20% working capital to revenue ratio. That ratio, depending upon what your revenue is going forward, that ratio should stay fixed. So if your revenue is going to decline from 10 million down to 8 million, you're going to need 20% of 8 million or 1.6. So whatever you have right now in your working capital, let's say you have chewed through your cash and you've stretched your payables, so you only have 500,000 of working capital, you really need 1.6 million. So that difference is the working capital increment that you need, which is the difference between 600,000 and 500,000 and 1.6 million, which is 1.1 million. You need that extra $1.1 million in order to operate your business so that your business could work. That isn't going to help your business grow. That isn't going to help your business get back on track and get back into the black. But what it's really going to do is it's going to help your business, once you're up to that as you're performing at that $8 million level, you'll be able to buy new product, you'll be able to collect your receivables, you'll be able to pay your people, you'll be able to pay your vendors. So that's your working capital analysis, and it's really a historical exercise. Then we have the growth capital portion of it. So the growth capital, the way you do that is you just budget out your business for the next year on a monthly basis and see what your burn rate is. Accumulate your burn rate. So if you're going to burn $50,000 over the next 6 months, you're going to have a $300,000 cumulative burn. That's the amount of growth capital that you need. So in the working capital, you need 1.1 million. On the growth capital, if you have a $50,000 loss and you're going to burn for 6 months, that's 300,000. You need $1.4 million of total transitional capital. We are at Attract Capital putting together a calculator for you called the Pandemic Transitional Capital Calculator. We're going to have this ready later this week. So if anybody has questions on the details and the inputs of how to go through this, you can contact us. We'll direct you to the calculator and we'll walk you through it. So what do you need to do this right, to calculate the right amount of transitional capital? You need to come up with some detailed 13-week profit and loss and balance sheet projections. And you also want to use specific backlog and pipeline revenue assumptions when you're looking at what your futuristic revenue is going to be. And there's a couple of overriding nuggets of wisdom that over the last 20 years that I've accumulated from working with growth companies in the middle market. And one of those things is that you always want to remember that things take usually twice as long and cost twice as much. So most people go into a capital event and think, well, I need $3 million. And I don't want to pay any more. I don't want to have a loan any larger than $3 million because I don't want to have to service that debt and it's going to cost me a lot of money. They'll talk to us, we'll look at the numbers, and we'll come back to them and say, we really think you need 5 million or 6 million. And we show them why they need it, because they need it for their working capital and they need it for their growth capital. And by the time we're done explaining it to them, they usually agree with us. So you always need more money than you think. And you really shouldn't feel bad about that, because in all my years of helping middle market companies finance themselves, I've always learned that it's never the price of the capital that you're paying, but it's always the amount of the capital that you have on hand. You need to have the right amount of capital on hand to get through this crisis and to come out on the other side strong so that you could take advantage of the market dislocations that are out there. So where do you get this capital? So now we talked about transitional capital and the two components of it and the specific exercises that you use to be able to calculate it properly. Where do you get it? There's 3 places to get it. There's banks, there's non-banks, and there's non-conventional places. So where are the banks right now? The banks are in a digestion phase because they are the front line for a lot of these government lending programs that I spoke of earlier. A lot of them are swamped with these programs, but at some point they're going to have to get back to business because interest rates have been reduced dramatically. And they're going to need to put earning assets back on their balance sheet. Most banks coming into 2020 had very lofty asset targets that they had to add to their portfolios. So they're going to have to get back to lending in order to generate income. But I would say by and large, 80% of the banks that we've taken the pulse of over the past week are in a wait and see mode, but 20% of them are lending. These tend to be smaller, more regional banks. They tend to be community banks. They tend to be banks that were conservatively managed in the late stage of the economic expansion. And they tend to be people that are looking for relationships, long-term relationships with good companies. I think the biggest thing that the banks are looking at in terms of wait and see is that it's not that they're worried about regulation from the Office of the Controller of Currency. It's not that they're worried about new regulation coming down the pike. It's really how to think about the recovery, because most people have never been through a pandemic like this. They don't know how the consumer economy is going to come back, how long it's going to take to come back. I think everybody believes that it's not going to snap back, but it's going to take a while. And so I think a lot of banks are trying to figure that out in their forecasting models. But the good news is that we just don't have banks. We have a large group of lenders out there that are non-banks. So who are these non-banks? The non-banks are they're called finance companies, asset-based lenders, they're called mezzanine lenders, they're called private debt funds, and some of them are even called private equity funds who have gotten into the lending business because they've seen the void. Some of them are even called business development corps, BDCs. These non-bank lenders have a fair amount of powder. They're stepping into the breach to provide funding to companies that need it right now. So these are very, very good people for institutions for you to have on your list. All of these are good targets. The key is as long as they're lending, much like 20% of the banks are lending right now, and they tend to be smaller and regional banks, you have to pick through these non-bank lenders and find the ones that are active right now who have kept their powder dry. And yes, a lot of these private credit lenders, they're more expensive, but you can get the amount of capital that you need from them. And right now, it's about getting your hands on the money and the right amount of money in order to carry your business forward. So, and there's one other way that you should be thinking about that I think is quite important. It's non-conventional sources of capital. And a lot of times, if you have a special relationship with a customer or a special relationship with a supplier, there's an ability perhaps to get some advance deposit money from them for the next order, or there's ability to get some credit support from them, and that should be exhausted as well. I think that that's a great way for people to look at it. It's sort of a form of off-balance sheet financing that if you get it in, it can be very valuable. So now that we know what the transitional capital is and who are the different lenders to get it from, you need a process. You need a full-on comprehensive process to attract capital. So I would advise every company owner out there to be incredibly smart and to take this very seriously, as if your business life really depends on it. Because as I said earlier, capital strength is destiny. If you have money and are in business, you win. It's not about how great your business is in terms of service, in terms of product, in terms of regional expansion. It's, are you in business and are you ready for the market? So you want to put resources on this process. Bringing in an expert who knows how to do this, who knows which lenders are lending, and knows how to calculate your capital need is a great idea right now. So you want to capital plan the right loan amount. You want to make sure that you have both working capital and growth capital. You want to target active bank and non-bank lenders. If you don't have those targets and you need to go outside of your region, you want to hire somebody that has the targets because you really want to go far and wide. You want to prepare the highest quality business plan that you can. You want to write your business plan as if your life depends on it. And the single biggest question you want to answer in this business plan is, why will you thrive and grow stronger in this new environment? It's not, you don't want to provide garden variety responses to, well, how are we going to get back into the black and how are we going to grow revenue? You want to make it look like you've sat up at night when you can't sleep and you're thinking about how you're going to add resources and really focus on the process of getting your customers out and getting your product and services out the door. This business plan should establish the greatness of your company in a strategic, operational, and a financial way. And it really needs to pull at all the stops. You also need to, in presenting this business plan, you need to be able to present the coronavirus effect on your business as a one-time extraordinary event, and you need to recast your historical financial statements in a way that will show the lender what your business would have been if the coronavirus hadn't hit it. And it's a difficult thing to do, but we've had some experience with looking back over the past couple of years and averaging it, coming out with a smoothing of your revenue, of your expenses, which will give a lender a better idea of what the different projection cases are. You also need to have a credible growth plan in your confidential information memorandum. You need to have a credible growth plan out of the recession that shows you getting back to normal levels of revenue and EBITDA. The key is, what are you doing differently to overcome the market challenges, and can you show the lender how you're going to be able to sell through the crisis? If you can sell through the crisis, then you've got a great company, because if you've been able to keep your people, continue to get product to your customers, continue to come up with new ways of addressing the market need, then you're the type of company that a lender wants to do business with. So highlighting how you've been able to respond to the crisis and how you've been able to sell through the crisis is incredibly important. And also in your financial projection, you also want to have kind of this growth case that shows you coming out of the red and into the black, and you want to have a steady state case. And you want to be very conservative in terms of how you're doing it. So if you have a full-on process to attract capital and you address all these elements, you've got the right focus on the lenders that are lending and the right amount of capital, both working capital and growth capital, then you will be ahead of the pack and you will be able to position yourself to come out very successfully when this horrible crisis comes to an end. And to the victor comes the spoils, and I think you'll be very strong. So I want to thank everybody for tuning in. We'll have another one of these in a few weeks. I hope you have a great day, and I wish you much luck attracting capital. And feel free to contact us if you have any questions on any of the concepts that we mentioned.